Today, a property market update. What's happening at the top end? Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian and New Zealand flavour. And today I'm joined again by Joe Wilkes. Hello, Joe.
Good morning, Martin.
And we're going to talk about what's happening in and around the top end of the market, which is looking pretty dodgy.
Yep, I think we'll talk about a number of things today. Looking at general increase in volumes around the country. I say volumes, not of sales, unfortunately, but of properties to buy, and some of the impacts that we're already seeing hit the top end of the market in particular, with a specific focus on one nice little suburb in central Auckland.
Okay, sounds very interesting. Now let's get started.
I've just to sort of talk about some of the numbers that we're seeing from a national perspective on spike in property availability. We talked back in January about nationally there were just over 32,000 houses available for sale across the country. So I suppose if you look at it, similar numbers to the numbers that you have in Sydney, similar population, similar number of houses for sale. That has, according to realestate.co.nz this morning, that spiked up to 38,472. So there's almost 6,500 more properties for sale, 20%, 25% more property, more stock in the market today than there was just 2.5 months ago. Auckland, I don't know how to describe it, Martin. When I was in property in the UK, we used to have periods where there's loads of houses come onto the market at the same time, and we'd say, "Oh shit, the market's just had an enema. There's all sorts of shit coming up." That's what's happening in Auckland. So they've gone from 11,200 in early January the 9th, 14,622 today. It's rising really, really quickly. Wellington seems to have woken up, so there's been a bit of press about what's going on in Auckland. It's still light and it's not as concentrated as it was while we were hyping the bubble last year. Most of last year, the stock of Wellington City properties, so this is not the Wellington region, there are actually over 2,000 houses available in the Wellington region now, but Wellington City last year stayed pretty constant between 500, 550 houses for sale, really tight market. Stocks hit 751 this morning, so there's a 50% increase in the amount of properties for would-be purchasers to acquire. So if something's triggering this, people are looking at what's happening and they're thinking, right, now's the time to sell. In Tauranga, which is another big market and a market that's really been fed by the Auckland exodus of retirees building houses for themselves sometimes and looking at moving out there for that cost differential from Auckland to Tauranga. Stocks have again gone up about 50%. They were hovering between 700, 800 properties throughout most of 2018. They've hit 1,265 today, so that's the Tauranga region. And Hamilton, which has really been hyped over the last couple of years as the investor's dream in lots of industry, agriculture, hour and a half or so south of Auckland. Good transport hub, lots going on, good services into the rural communities and good connections generally with the rest of the North Island. Been an awful lot of building going on up there, and some of that's hit the market now because we've gone from around 600, 650 properties, pretty consistent again throughout 2018. That's hit over 1,000 this week, so it's gone it's 40% or so higher. So things are taking longer. The stock levels are rising quite quickly, and there seems to be a general malaise from those that are being encouraged to get into it.
Yeah, very interesting. Well, I actually had a conversation yesterday. I actually recorded it, and I'll put it up shortly, with a property investor who lives in the South Island, so in and around Gore.
Yeah.
And it's quite interesting because his argument is that down in the south, things are still looking okay. But of course, the average property price down there is $200,000. It's like a different world, right? And he's basically saying, well, there's still enough demand. There's still quite a lot of people wanting to move and buy. And don't think that Auckland and New Zealand are precisely the same. But of course, in the weight of population, a lot of it's up in the North Island, a lot of it's around Auckland. So frankly, from an economic perspective, what happens there is probably most significant.
Yeah, well, I think we're going to see. I mean, if you've got those numbers of people approaching retirement with debts, you are going to see people making lifestyle decisions and trading out of their debt position to go to other places that maybe they wouldn't consider had they paid off the debt. It's typical late cycle stuff. It's exactly what you've seen with Hobart last year, and they've started to turn now. The price differentials, people look at absolute price, and funny story for you. I spoke to an Auckland mortgage broker earlier on this week, and they were talking about a client of theirs who's a New Zealand resident, but of Chinese extraction, and moved over here in their teens, now in their late 30s. They owned a property, $130,000 household income, owned a family home which reportedly was worth around 1.6 million, but with a mortgage of $1 million. Separate to that, they have 3 buy-to-lets, one value of around 1.4 with a mortgage of 1.2 million. A second investment property with a value of around $1 million and a mortgage of about 800,000. And third to that, a property, smaller property, bought at 500,000 last year, mortgage of 420,000, I think. What I found really interesting is that it was the only the family home where the debt had been raised within New Zealand. So the family home had an ANZ mortgage on it. The other investment properties, the funding had actually been raised against a family home in Hong Kong, arrived deposits and mortgage money coming from the China Construction Bank. So we've got a headache, and I thought I'd delve a little bit deeper into it because the auction results in Auckland have been horrific. The only people who really report on their data transparently are Barfoot and Thompson's. Throughout March, you talk about clearance rates of just under 50% in Australia being abysmal. We're struggling to get over 29%, and it's been consistent throughout March, 28, 29%. The weight of where the rates have been higher in terms of clearance have been in the poorer, I'm going to say crappy areas, a bit like Gore. No, I shouldn't say it. I didn't mean that about Gore. But there have been in areas where it's still affordable relative to where it isn't. But in the prime central locations, the auction clearance rates have fallen off a cliff. There have been a couple of auctions where 30, 40 properties offered 11, 12% clearance rates. Some of them have tipped into the early 20s, but generally the prime markets, the prime central Auckland suburbs, where there are only 3% foreign buyers, but that's where all the money was going. We're now seeing auction rates fall off a cliff. So I thought I'd look at Remuera. There's a lot of famous people have lived in Remuera over the years, former prime ministers, and we've got TV hosts, and there's always a big clamour in New Zealand. We like to talk about what someone famous has sold the house for, so there's been a lot of use on that over the last year or so. I'm sure it's no different in Australia. But I looked at Remuera from 2 angles. One from a what's on the market today for sale. When was it bought? And what's the breakdown? How long have people owned these properties? So just going to run through some quick numbers for you, which I'll find in my pile of papers. So I did this last Friday, and it's changed a bit. There's a couple more properties available in Remuera now, and we're talking upper end of the market. You've got various asking prices, lots of by negotiation, particularly on the top end. Lots that will be offered for auction. I don't know why they're bothering, if I'm honest. They may as well just put a sticker price on it. But of the 197 properties that were up for sale, this will astonish you, 18% of those houses, Martin, were bought from 2016 onwards. So people are holding them for no time at all. And some of them we are now seeing returning back to the market for less than they were bought for, which is quite significant. I've sent you the links for these, so I don't know if you want to attach these so people can see the raw data. I think we'll just share. That's the raw data. You can look over it. Further 17% of properties, so were bought between 2013 and 2015. And then 14% were bought between 2010 and 2012. In essence, you've got 35% of the market. If the market 13, 14, 15 was boom time, 16 was peak, it's flatlined, it's starting to decline now. You've got 35% of the currently available houses to buy were all bought within the 2 years of the peak and what we're now seeing, nobody wanting to buy them. So we have got a headache. It's not a surprise the Governor of the Reserve Bank of New Zealand is thinking about lowering the cash rate because we've got to try, I think, and replace a lot of foreign raised credit, which with the overseas ban can't be replaced by normal Kiwi income. So they just can't get there. I also took a look at the rental market for Remuera. Again, nice affluent place. And I was pretty generous. So what I looked at was the address of the house. So I've included all the addresses so people can see the addresses. Where I could find a purchase price and the year that the house was priced. So this is gone. I've actually had to go to a number of websites to get all this data. 19.1% of all the properties that are available for rent in Remuera were bought from 2016 onwards. So from the boom, on we go. And some of the yields, and I've been really generous on the yields. I've looked at gross rental yield against purchase price. So acquisition price, what's your yield? Remembering you can borrow money at 4%, a little bit more if you're looking at investor loans. We've got people accepting 1.8% yields. I've got somebody accepting 1.72% yields. We've got a few that were purchased before God was a boy. They're getting reasonable returns if they bought in the 90s. But there's a huge amount of stress. So 19.1% were bought from 2016 onwards. A further 17% were bought from 2013 to 2015. So you've got 36.1% of all the rental stock that's available up there in Remuera. The nicest part, they'd argue it's the nicest part of Auckland, bought within 2 years of the top of the market, and yields are atrocious. That doesn't factor in. You've got to insure the bloody property. You've got to go and cover the rates and pay for somebody to manage it. So some of these yields are generous at best, but most of the later yields are in the, and this is before costs stripped out, 1s, 2s, 3s. There's a few 4s. People are breaking even. Negative gearing allowances are disappearing. We've got a headache. We've got a headache coming.
Well, it's interesting. Of course, I calculate gross and net rental returns for Australian property through our surveys. And if you look at it on a net rental basis, so that's effectively taking account of some of those other costs, like the cost of the mortgage and everything else, right? So effectively looking at the true returns, half of all investment properties across Australia are in negative territory, right? Excluding any capital gains or losses, right? So just on a cash flow basis, half of investment properties in Australia, people are losing money week in, week out, month in, month out. Now, what's interesting is when you ask those households about that rental property, they have no idea about what the true returns are, because essentially all they know is roughly what the gross return is, right? And the gross returns vary. In some areas it's sort of 1 or 2, 3%, and a few others it's up to 4%. These are not sustainable economic propositions.
I'm just astonished.
Yeah.
The brokers have been allowed to go and write the loans. The banks have actually gone and taken it on board because, last 10 years I was in the UK. Well, you had to go and provide what your rental income was going to be. They used to assume. I mean, I'm working on 52-week occupancy to get these numbers. Yep. I'm being incredibly generous on. In the UK, they tend to work on your rent needed to cover 70% of your outgoings. There's no bloody way that we're going anywhere near that here.
No, absolutely. Well, of course, APRA recently changed the rules so that you could only take 80% of the rental stream rather than 100%, because, of course, occupancy is not always there. So what's fascinating here, of course, is people were fixated on the capital growth. So they were happy to take negative returns on an ongoing basis because they could see this wonderful prize of this massive capital appreciation over 2, 5, 10 years, right? That's completely changed. So the whole proposition of investment property investing looks to me to be shot.
Yeah, it's shot to pieces. And the big thing that we've got, we don't know what headache and hangover in Australia and New Zealand that we're going to see when the deleveraging starts in the Chinese housing market. They've got 70% of their wealth tied up in property. We've got 65% over there. Our household is probably pretty close. I think 60% there or thereabouts. When that deleveraging starts, and people are selling, are they going to be selling assets? Is a bank in China going to call on the asset in China, or are people going to offload here? If the deposits, this is a big question I don't understand. I don't know how I can find out, but if the deposit's been raised abroad, but there's a mortgage held by a local Australian or New Zealand bank, who's going to have first call? Because the cash, if the cash has been raised offshore, and we hit strife, who's going to have the call on the house?
Yeah, well, it's a very interesting conundrum. And specifically, of course, you've now got China, who is, as part of their sustainable strategy in terms of trying to keep the economy going, they are looking to repatriate capital from overseas. And they're trying to encourage Chinese now not to invest in property, either overseas or in China, but in the stock market.
Yeah.
So there's a massive swing going on, and they've put all sorts of barriers now in place. So, we're going to see a flight of capital back to China, I think, and that's going to have a huge impact. And as you say, it's going to create all sorts of headaches in terms of, who owns what bit. Another example in Australia, we've had a lot of Chinese investors who bought off the plan 18 months or so ago, right?
Walking away from their deposits.
And the question is now, will they just walk away? And, are you really going to go and find somebody in China and try and get them to cough up the rest? It's not going to happen. So it's going to be another of those factors, which is going to be a downward force on the market. And it amazes me that some of these factors that we're talking about here, right, are just not discussed in the mainstream media at all. It's just amazing. I'm still seeing people saying, property investment, great. Capital buyers market, prices are down. Now's the time to pile in. Interest rates are low. Easily affordable, and I'm thinking, no, you're missing the point.
Yeah, I mean, we did it in the UK. They did it in Ireland. They did it in Spain. It just seems that we're repeating the thing, and it's obviously something to do with the Western world's mentality towards their children that we want to eat our young. We can do lead them to the slaughter, and that's why I'm doing this, because we really aren't providing any proper thought about how these things can impact the next generation, because it will be them holding the can. We're getting an increase in first-time buyer loans as a proportion. It's rising. The easy lending is still there. The LVR's easily overcomable. That's probably why you've got a lot of these 50 to 64-year-olds still carrying, 60% of them still carrying mortgage debt, because they are helping their siblings. It's an absolute bugger's muddle.
Yeah, and I don't know whether you saw, but I posted on the Bank of Mum and Dad, right? So suddenly the Bank of Mum and Dad's falling apart, because essentially no one now wants to actually raid equity in their property when their value is going down to pass it across to their kids. So it's all part of this same dynamic of, easing momentum. And the other point about those older households with mortgages, what's fascinating about that is they were, of course, banking on being able to move into a smaller property, release equity, and repay the mortgage at the point when they wanted to retire.
Yeah.
Now, if prices continue to go down as we expect to see them, that formulation is just not going to work. So they're going to be stuck with a mortgage into retirement.
Well, what I saw in the UK was the flat lining of the top end of the market. So houses that were worth 1.5 million in 2006-7 before the crash, they dropped to $1 million. They recovered a bit, and then they've largely stayed flat for years. Yeah. Meanwhile, the bubble and the credit growth has continued, and the lower end of the market, you've seen this compression. So what people thought was a $500,000 differential, I'll take that out. I'll pay the 100 grand left on the mortgage off, and I've got 400 to play with. that just compresses, and you may find that people who are trying to pay that mortgage off, they're left with 100 grand rather than 400 that they were planning on. It's no surprise we've got such a high involvement or participation rate in the labour force. People will be bloody paying this until they're 80.
Yeah, exactly right. And of course, the issue is that it's very hard if the momentum does ease and if sentiment changes. You get that feedback loop, and it's very hard then to turn it around. And people need to understand that we're likely to see home prices go sideways or fall, not just for a year, not just for 2 years, but this could be 5 to 10 years. And my challenge to anybody who owns a property is: have you thought through what might happen if that is the scenario? If there's no capital growth in your property, right? You should be planning for that scenario.
Yeah, indeed. And those 1950 birth years are 69, and the spike comes in the next 5 years. We've got a problem that's building, and you and I have talked about the baby boom time bomb in the past. Fitch Ratings have come out with some analysis over here in New Zealand, and this scared me a little bit, if I'm honest. We've got the positive. 70% of households in New Zealand don't carry a mortgage. So if you look at that from a societal perspective, the debt's concentrated on 30% of households that do. Yep. The challenge you have, though, in New Zealand is that 35% of households rent. So they don't have a mortgage because they're renting property. So actually, you've got half of those that don't have a mortgage don't own a property. I'm presuming, or very close to half of those don't actually own a property, and they'll be at all walks of life. So they'll be from 25 up to 65 and up to beyond and into retirement. That's a bit scary, because that's a social headache coming further down the track when you've got to pay for all of these people who come out of the workforce and don't own any assets. Then we've got some even more scary stuff from Fitch. 62% of the 50 to 64-year-olds in New Zealand still carrying a mortgage. So we're carrying this debt right up into the final days of our working careers. And generally, I grew up with the whole mentality of, when you got debt, pay it down, get rid of it, and then start saving for your retirement. But debts usually cost you more than than the returns you'll get on non-risky assets. So pay your debts down and then start saving. I'm guessing there's a lot of those, that 62% who are carrying a mortgage in the 50 to 64-year-old bracket, who don't have a lot beyond the state pension when they hit 65. So the time bomb's building. Those 1950 birth years are 69, and the spike comes in the next 5 years.
Absolutely. Yeah. Interesting times, Joe.
Yeah, tough times, and we're starting to see the impact of it, and it's hitting the top end of the market.
Yeah. Thank you very much for your time today.
Appreciate it, Martin.
Thanks, Joe, for that. That's very interesting. And clearly, the top end of the market looks a bit wobbly. Of course, the concern I have is that then flows down into the broader market. We'll see what happens. I'm Martin North from Digital Finance Analytics. Many thanks for watching. Talk to you next time.